Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, Senior Market Analyst for Barchart. And we're seeing kind of a mixed trade in the grains this morning. Livestock futures trading lower. And Darin, it was a tough down day and everything yesterday. Some risk aversion there with Fitch downgrading U.S. credit, and the stock indices also reacted to that as well. But you think it was just kind of a blip on the radar?
Yeah, I do. I mean, it was interesting looking at the close Wednesday afternoon. Every sector from financials through the commodities were in the red, or at least they weren't green at the end of the day. So it did look like there was kind of a widespread, let's get out of our positions and recover and see where we go from here. Now, as far as the U.S. stock indexes go, I don't see the Fitch thing as that big of a deal. If we go back and read, they've been talking about poor U.S. credit ratings basically for the last 3 or 4 years. And it's just now they decided to lower the rating, they actually lower the rating. So I just don't see it as a huge deal. To me, what we're looking at here in the stock markets, yes, we closed lower on Wednesday. From what I understand, it's a little lower to open the day here on Thursday. We've closed many of these indexes, both the S&P and the NASDAQ. We've closed higher 5 consecutive months. And at the end of July, both were at or near their monthly highs. So that kind of opens the door, opens a trap door, I should say, for some selling to come into the market. Take some money off the table. They're a little bit overdone, a little bit overbought at these levels, and let them come back for a while. Let them settle back. And then, as we head into fall again, later into the fall, we'll probably find some buying interest.
Yeah, and I started off with that because it was such a dominant influence on the commodity sector yesterday with everything down. Also, we've been trading weather, more favorable weather. Do you think the fact that soybeans are up this morning, have we taken out enough weather premium, or is that in response to pretty decent exports and some more business to China this morning?
I think the biggest part is it's just kind of a back and forth in the soybeans right now. I think the bigger picture is it's just not as bullish as it was before. But from a fundamental point of view, we saw what the switch from La Nina to El Nino did with Brazil's crop. It all quickly grew to where it's been reported as record size. Yeah, we don't have huge acres. We did see a reduction in acres here in the U.S., but with the way the weather has changed, it certainly looks like yield's going to continue to improve. So production should continue to go up. Supplies are going to increase. And the issue remains demand. Yes, we're making some small sales to China, but again, they're just kind of hand to mouth. We're still a secondary supplier. They're going to step in with the U.S. soybeans melting down the way they have. My biggest concerns right now is we are seeing some pressure in spreads, but it's basis that's just collapsing at this point. I think we've lost something like almost 20 cents in basis alone so far this week, and we're only at Thursday morning. So I think it's something we have to keep an eye on, certainly indicating that the commercial side is growing very comfortable with longer-term supply and demand.
So during that grain basis breakdown, not just in soybeans, then in all grains?
Yeah, we're seeing some of it in corn. It's not quite as severe in corn. We're still holding a pretty good premium to the September contract. And again, what I see here is that the U.S. supplies have been tight throughout the 2022-23 marketing year. Yes, demand is slow. We've seen a slight uptick, but nothing to get too excited about as far as export numbers go. But we have seen a bit of an uptick. Basis is holding firm. Without really strengthening all that much. The markets that we really see a hit coming is in the wheat. All 3 classes of wheat are running very weak basis at this point. With the fundamentals in Chicago, actually some of the most bearish that I've seen over the last 30 years or so.
Wow. And what do you attribute that to, those that bearish outlook for wheat?
Basically, I mean, we can make all the noise we want to about Ukraine and Russia blowing up ports and grain facilities and all that, but it doesn't change the fact right now it seems the world just doesn't want U.S. wheat. And it comes down to, if there's 1 bushel of wheat left over, it's too many. Now, all that being said, as we look at the latest weekly export sales and shipments numbers, we are seeing a trend towards increased wheat exports from the U.S. So, I mean, this is something we've been looking for. Right now, it's not making that big of a difference in the real fundamentals of the market. And as we're talking about this, it's interesting to note that the September-December Chicago spread was covering 100% calculated full commercial carry at Wednesday's close. And this is a big deal, because if we continue to run this high, if carry continues to stay this strong in the future spreads, we could see where variable storage rates start to kick back in. If we're still running this strong on the 25th of August, by the time we get into mid-September, those rates are going to change. Those official storage rates will change.
And since we're talking about weekly exports and shipments on corn, still not very good, are they?
No, we're still on pace to ship about 33% less than we did last year. That's where we've been. There's just nothing really happening there. It's staying pretty stable. So again, exports are the smallest of the three legs of demand for U.S. corn. The big concerns are feed and ethanol, and feed demands come down as well with the fewer cattle. Ethanol's been stable, but exports are running slow. We're not really building a lot of sales for next marketing year either. So, again, it's going to be a concern, particularly if, all of these acres the U.S. supposedly planted produce relatively well. And as we can see in spreads, the commercial side, again, just is not as bullish as it was before. They're growing more comfortable with the production possibilities for later this fall.
Yeah, and we're down into, we should talk technically, all the grains are down into some pretty key support areas here. Soybeans kind of bouncing off a bit, but we're flirting with it here in corn, aren't we, this morning?
Yeah, I think the prices we really have to watch are September at 474 and December at 481. Those are the July lows. If we can hold those levels, then maybe we can start to find some renewed buying interest. My concern, if we look at the cash index, if it continues to break down, and if we post a new low monthly close here at the end of August, I know it's only early August, but if we post a new low monthly close for 2023 at the end of this month, then we're still on that path laid out between 2010 and 2014 that we've been following here from 2020 to 23. And that would suggest, and I'm not a big believer in analogous years, but it would suggest that we've got more room to the downside with the cash market possibly not bottoming out till next spring, maybe early summer.
And let's talk about weather, because we do have 7-day forecasts, which look like the northern part of the Corn Belt and the northern plains are going to get some pretty good moisture. If those confirm, how negative will that be for corn, beans, and even spring wheat?
I would think we would continue to see some pressure. I mean, the interesting thing is funds are still, or at least were still, long the corn market as of a week ago, this past Tuesday, with the latest CFTC commitments to traders report. So as long as they're still holding that leaves some room for the downside, particularly if fund liquidation continues. And also, commercial is going to continue to get more comfortable with this position. They're going to continue to sell. That's going to put pressure on the nearby contracts, so more on the D's contract. So that would make it seem like that 481 is going to be tough to hold if this weather plays out.
Yeah. So the cattle market, let's talk about that one, because we sat back yesterday in response or in reaction to what was going on in outside markets, stock market included. Today we're down again. But we've had not much cash trade. What we've had has been sloppy, and choice boxes are back down again. So are those contributing factors?
Oh, they certainly are, Michelle. I think we have to look. This market, as you and I have talked over the last few weeks, these cattle markets have been looking a bit top heavy. And, as we move into August, there's not as many contract cattle, but there's some contract cattle coming through here early in the month, through the first half or so, that, we're going to have to wade through. And as you said, with the cash market's been relatively undefined here the last couple of weeks. We've seen a little bit of trade done late in the week, but not a lot of strength. Those who are looking to sell are holding off. Bids are coming in lower. Packers are looking at box beef markets coming down, so they're really not willing to push the market, knowing that contract cattle is coming out. So again, we're just kind of at a stalemate right here, and futures are reflecting that, coming under a little bit of pressure.
Yeah, and choice boxes were up there when the Packers were cutting kills. We'll see if they can keep that going for a while here or not. All right, so let's end with crude oil, because we went up, tested the top end of this trading range that we've been in here, but yesterday got caught up in the macroeconomic sell-off. But what do you see longer term for this crude oil market?
Right now, I still see it moving sideways. It's something like a $20 range, if I recall, something like 82 to 62 or something like that. And, we did see news this morning that Saudi Arabia was going to push its production cuts at least another month back out into September. We'll see how the market reacts. So far, it really hasn't been able to break the market out of this sideways trend. To me, it's going to come down to, can we post a new 4-month high with the spot month contract? If it does that, then I think we're going to see some buyers come in. We're going to see some algorithms kicked in. Until then, I just think it's going to be a lot of chopping around, and we'll just have to wait and see where the money flows. I mean, if some of this money that starts to come out, if it starts to come out of stock indexes, is it going to go over into the energy complex? Is it going to stay in the softs? Because that still seems to be kind of the hot sector, just different markets at a time. Or are they going to settle into something like energies and metals?
Yeah. And do you think the rally that we've had here recently, has that been geopolitical, or has that been a supply demand thing, or what?
That's a great question, Michelle. It's almost always geopolitical in the energy complex, in crude oil. But we could still look at those spreads and we still see that they're inverted. So this, the forward curve is inverted. So this tells us that supply and demand is still an issue, that there is still a layer of fundamental support underneath this market. Once we get through all the geopolitics, it still comes down to supply and demand.
All right. Thanks for joining us. Darin Newsom, Senior Market Analyst with Barchart. That's Markets Now.